17 years of retirement, which is half the number of years you worked. You know, the reason I'm spending a bit of time here is so that we start putting perspective of how important another 17 years plus when you're still able to generate something for yourself in passive, because you're now not happy. The challenge we've seen in this country over the last couple of researches done, including a recent one by the World Bank, is that 70% of Kenyans retire with less than $1 million shillings. 70% of Kenyans retire with less than $1 million shillings. So you've worked for 35 years, and your pension is put together, and maybe your small savings. When that is accumulated, it's less than $1 million shillings. You have 17 years ahead of you, and you're now frail and cannot work. So how do we ensure that we put money away over time so that the 17 years are not 17 years of agony, but are 17 years where you can hang out with your grandchildren, with your children, friends, attend to other matters of ministry and sport and things that you enjoy. And it takes me back to a quote by Oscar, which says that when I was young, I thought that money was the most important thing in life. When I was young, I thought that money was the most important thing in life. Now that I am old, I know it is. For Christians, this doesn't in any way conflict our belief, because we know God provides and we believe so. But even in His wisdom, He has given us that mind to generate wealth. And therefore, the later years, we have a saying in my French speaking background, that the old times will challenge the younger ones and ask, what did I do when I was young? And this is really what it is. So let's think about those facts that we've talked about here, especially that 70% of Kenyans retire with less than $1 million shillings. That is critical. And this presentation, going forward, will be around how do we make sure that we're not in that 70%? How do we make sure that our loved ones are not in that 70%? How do we empower people to make sure that you retire or they retire or we retire, not just because you've reached the age of 60, but you have sufficient passive income that you can retire early. We'll quickly go through a to-do list. If I want to retire in the next 15 years, for example, what will that look like? What do I need to do? Yeah? So we need to look at a quick to-do list with a few items. Again, hold this in your thoughts as we go through the next slide. But one of the things is to build a freedom fund. Now, a freedom fund is that fund where it will be giving you income over the years. It will be giving you income in your retirement time. The next one is to understand, read, discuss, listen, and explore issues around investments. We don't need to fear about investments. We need to explore. We need to understand. Let's not, that when the business news comes on TV at 9 o'clock, that the Nairobi Securities Exchange is, that's when you go to the kitchen to check whether the dinner has been done or fruits are ready for dessert. No. That is the time to sit and listen. How has Safaricom share done? How is the other counter or the other one doing? That is when you get to hear what is the global market saying, what is going on in the US, what is going on in Africa, what are the opportunities. Understand, read, and discuss, listen. Journals on finance, make them your friends, understand basic finance and investment. Think global, not just local, think global, and we'll be able to talk more around that. Think about other investments. Normally we see people investing normal trades in bonds or shares. Think about other commodities. You can do foreign currency trading, you can do commodity trading, and stuff like that. Think long term, not necessarily short term. Yeah? Money and wealth is created in the long term. There is this disease that is very serious in this country of get rich quick. that you get some opportunity today, and tomorrow you cannot explain to your son and daughter how you met your wife because you're not even sure. It is something you can discuss with anyone during daylight.
So look at the short and the long term, investing and trading. Understand fees and taxes. The opportunities where you actually get investment returns that are tax-free.
And you'll be able to talk about that. And low management fees. Invest with trusted regulated entities. That is important. So this is your to-do list. If you think about investment and be going into it, you have to work with partners that are regulated because then you have the cost. And then lastly, be patient with yourself and with your investing. So as we go through the next couple of slides, I want those points with us. Have them there at the back of your mind. As we discuss each point, each avenue of investment, we ask ourselves, yes, we will have the patience to see through this opportunity. So what's next? We need to draw a plan, right? Yeah? We need to draw a plan. It's determine your investment destiny. Are you at 15 years to retire? Are you at 5 years to retire? Are you at 2 years to retire? If you are with 2 years to retire, then we need to send you on an accelerated saving mode. Yeah, because time value, the longer you take to put money together, the likely to grow faster. And therefore, if we are going, and we'll be talking about compounding in a short while. But what is critical is really to embrace a saving and investment culture. Create and embrace a savings and investment culture. Savings is not the money that you put away after you've spent everything else and that's what is left behind. Just like the tithe, it is one of those things that comes up first. You know the way you get a gross salary and then you pick the one that is going to the bank, that as net. The KRA has taken their beat, NSSF has taken their beat, pension the contribution has gone, NHIF has gone, and you're left with the net. The tithe should follow, and then the savings and investment plan should follow thereafter. It shouldn't be after you've paid this and paid rent and paid, yes, and I'm not saying you shouldn't, but be deliberate. Be deliberate. Take a percentage and say, we'll be able to save 5,000. I'll be able to save 10,000. And we'll be able to see in the next slide what that looks like. Yeah? It's never about the big money. It's about the discipline. It's about the discipline. It is not hundreds of thousands. It is the discipline. If you have a running tap, that when you close it completely, there are still drops that keep dripping down. And you put a bucket, and you let it run there for a week. What will happen to that bucket? It will be full, right? So that's a mindset. It doesn't matter whether it's a quick flow or it takes time, the bucket will get full. Now, the difference between the 25-year-old and the 45-year-old is a 20-year age difference. And when it comes to investment, then the 40-year-old will need to push the tap faster, while the 20-year-old will be okay with the drop, but consistently over the 25 years to get to where that is. So embrace saving culture and savings. Put a percentage, pay yourself first. That's what I was talking about. Tell yourself, oh, Sam, I've worked so hard this month, I've worked so hard this year, that I'll be able to put away 5,000 every month. Nijirudishie asanti. Niseme asanti kwa mwili yangu because it has helped me work and work very hard. So as you pay your tithe and pay anything else, put a percentage of your earnings away, a part of your income. Then how far are you from hanging the boots? That's what we've talked about. A young man who is 20 and an older brother who is 40, the issue now would be their window for retirement is shorter, and therefore they need to invest at a higher rate. When you have time on your side, the benefits of compounding is very key, and we'll be going to see what impact compounding has when you talk about investment. The last bit there is really look at your investment destiny. I want to retire when I have X amount, or I'm able to generate X amount of income to cover my usual overheads. What are my monthly costs? If you have children in school or college, this is what they pay. If you have you don't have your own home, then you have this rent to pay. If you have your own home, then you have the rates to settle and power bills and those things, maintenance of the house and stuff like that. If you drive, you must have a budget for insurance, replacement of tires, and so many things. So you must be able to tell yourself, my monthly costs are X, say 100,000 for example. And therefore my passive income needs to be at 150 so that I have these other 50 as additional float that can come in for any emergency, illness, and to support others. So one must be able to tell the level of income and now level of expense, and now look at the level of income that will be able to cover that, especially more into the retirement. Compounding is an interesting concept, and it goes to that dripping of the water in the bucket. The drop that found the other drop and found another drop and found another drop, and the bucket is full. When it comes to investing, remember, you're not pulling away that money from that bucket, yeah? Or that water is not being pulled away to go and wash the car or wash the house. The bucket will start getting full. When it comes to investing, it's the same concept. So on January, say you decide as a couple, you and your spouse, or as an individual, you'll have to put away some, and I said you can start with any amount. Can we say 5,000? So Mzee, 2,500, Mama, 2,500 every month. You set it away and say, this one is going to our freedom fund. You remember the freedom fund we talked about? Yes, it goes to your freedom fund. 5,000 every month for 12 months is 60,000. So after year one, every month, January to December, 5,000, 5,000, 5,000. As a start. Simple, not big things. Just put away 5,000. Next month, 5,000. The other month, 5,000. In 1 year, you'll have, from January to December, you'll have put 60,000 shillings away. And it's doable, because you'll just sacrifice a few things and say, okay, 5,000. If you put that money at maybe a 12% rate of interest currently, and you take it for about 25 years. So what I would recommend if you is putting an investment fund or a freedom fund is you start small, but be consistent like we had said. However, because next year God will be faithful and he has remained faithful, you may have a salary increment of 10%, 5%, put another, the same way that has grown, put your fund also to grow with the same rate. So if you got a 5% salary increment, add your 5% onto your savings plan as well. So now don't put 5,000, put 5,500. If Mama also got a bonus or something, put it there. Now you move from 5,000 in the next year to 5,500. After 1 year, that money again will have grown. Now from the 60, this continues to grow. Remember the interest, the 60 is also earning interest. This 5,500 now for the new year, the second year, will also earn interest on a monthly basis. It accumulates. In the third year, take now the 5,500, and God has blessed you. You've even changed jobs. You got a 30% pay rise because you've moved to another company. You are chief accountant, now you become the senior most one. And you're now earning a little bit more. Add that also. And continue building that faithfully over the career. If I do the mathematics, and unfortunately you're not able to see that very clearly, but I need to demonstrate this. Say this guy started in the year 2000. Year 2000 is about 21 years ago. And he started with 5,000 shillings with his wife, 2,500, 2,500, earning 10%, 12% per year and increasing it annually by 10% because of the cost of living and, At the end of the 10th year, they are looking at 4.4 million after 10 years. By now, for somebody who started in 2020, in year 2000, and is now year 2021, by the end of this year, they'll be looking at 11.4 million. From the 5,000. From the 5,000. So that bucket is getting full. Now, when somebody has a fund, freedom fund of 11 million, and you can see where it came from, eh? We are not talking big figures. We are not talking about the rich and the wealthy. We are talking about ordinary Kenyans like you and me. But the consistency. So these young guys I'm seeing here on the sorting out our IT are young people with opportunities like this. The elderly, we are of opportunity to do this. By the time this guy is retiring, so he'll work for 35 years? Assuming he wants to retire after 25 years, he will retire with 22 million if he puts the money for 25 years on that plan. 5,000 a month for the first year, then move it to 5,500 the second year, continue adding 10% year on as they grow, him and his wife in a freedom fund. However, you don't pull this money out. This is a fund, you say, this is our retirement fund. By the time they're going to retire, actually by 25 years, they can now move away and forget about any other income because they'll be generating annually 2.2 million a year. They'll be generating 2.2 million a year. If you divide that by 12 months, it's almost 200,000 net every month. So one can retire, right? So the question is, this is doable. Listening to where it starts at 5,000, but then you need time. Meaning that if your time is shorter, then your investment will not be 5,000, it will need to be more, so that you get to a good fund by the time one is retiring. This is a simple exercise around the power of compounding. When you have debt, it's now the reverse. So if you went to the bank and borrowed 5 million for business, and you continue paying, now you'll have paid the bank or the people who lend you the money the same kind of rate. And therefore, it is important to look at it to work in your favor. Take advantage of the power of compounding to make money for yourself. It's a very, very powerful thing, and it would be nice to go try it out and see how good this works. Many people don't understand this concept because they've not tried it. But once you try it, live it, you'll be surprised how far you can go. When one gets a lump sum, you get a bonus. You can imagine if you put it here. That accelerates it faster because what you're putting month on month can be put quickly and cover even 2 years or 1 year because you got a lump sum. You sold a plot that is somewhere that is not making much money for you. You sell it and put that money in your freedom fund. The returns now move to some huge amounts. So the potential there is very, very good. Sources of income, I will not dwell much on this. We know them, either rent income, income from business, dividends from investments that you have made, interest on like what we have just described in a deposit or in a corporate bond or in a government bond or government paper. Pension, you will receive pension. It can be in annuities or lump sum. So one retires and you elect, can I get my 1 million shillings or can I get it in annuities over a long period of time? Insurance bonuses, those who take insurance policies, they would pay a bonus at some point and maturities. They would give you take a policy, 8-year policy. After the 8th year, it gives you 25%, then 25% the next year, 25% the next year. In 4 years, you have your money back. Royalties, those who write books or sing songs, you can continue to earn this into the long term. Excellent opportunity, source of income. The important thing here is determine which of these sources of income will be generating you the passive income. Other than number 2, which is family partnership business, because that may need you to be active, but rent is just sitting and the agent collects for you and puts in the bank. Dividends, Equity Bank makes money and declares a dividends and you put in the bank. Interest income, you don't need to lift a finger. The bank just puts the money into your account and you go and withdraw and pay your bills. Pension is over time. Insurance, again, the same thing. Royalties, the same. So these are also areas where one can put in money thinking long term. Opportunities that are available for you and me. Fixed deposits, these are very well known to you guys. Everyone does understand this around fixed deposits. Put money in the bank uses your money to lend to others, they make the money, and you get a deposit. You get interest. Treasury bills, this is government paper. Again, it can be 90 days or 182 days, that's 3 months or 6 months. And the yield there is somewhere between 7 and 10%. Now they're a bit low, could be 7, 8%, not getting to 10. But treasury bonds, these are long-term, could be 1 year to 30 years. The longer the tenor, the more the interest. We have just closed, there was a closure of a bond 2 weeks ago, and the yield was pretty handsome, I think 12.75 or thereabout. Interest-free bond, so a tax-free bond, it's an infrastructure bond. So the government goes to borrow money to do the superhighways and the expressways, and for that they give you, to motivate you as an investor, you actually can place that and pay no tax. It's tax exempt. So you get your interest every 6 months, interest-free, tax-free, which is very good. Then shares into listed companies, the likes of Safaricom and others that are in this market, and we'll be talking about that as we go on in the presentation. And then capital gains also. You've seen shares, Safaricom, I think in 2008, it went to the stock market at 2 shillings and 50 cents, and we all rushed to buy it. And then it moved up to 5 shillings, and it came down to 2 shillings and 70 cents, and we all sold. Today that share is 41 shillings, 42 shillings, and that's what patience is about. And we'll talk about patience. Remember, in the other slide, we talked about take time, be patient with yourself and with your investments. Wealth is made in the long term. Real estate, and I know in Kenya we are very good in this one, buying plots in Kitengela and Kisaju and Nyanyuki, good places. Where you talk about land bank, where you actually buy land, sit on it because you think there will be a good road coming, or there will be an industrial park coming, or their capital gains are likely to be realized. Again, capital gains there would be with a period of 1 year to 3 years, you're likely to get somewhere between 15 and 20%. So it's also a good investment. Property for sale. So you develop land, you buy land and develop units for sale. It's a good one. And also develop for rent. Develop for sale, depending on the caliber, whether you're doing the high populated density, there the returns could be a bit better because there is demand. The rentals income could be somewhere in the range of 15 to 20% return. But on rent, it's long term, so the returns are a bit lower. They will be somewhere between 5 and 8% net of tax. So those are opportunities that are available in the market today. We also have what we call collective investment schemes. Collective investment schemes is actually a term used by the Capital Markets Authority within the capital market space, and it means that all of us in this room come into one fund. We pool the resources and synergy into one fund, and therefore it becomes build critical mass, and we can be able to then attract good returns. So you and I will go into what we call a money market fund. It's an easy one, low risk, where you just go and take investments. It's very similar, mirroring a bank deposit or a commercial bond, like what you saw recently done by Family Bank. They issued a bond at 12.5% per annum, so that will mirror that kind of investment. Then you have the fixed income fund. This would be a bit of a high yield. It would include government paper. The yield is slightly higher, maybe around 12%, and again is fixed for some time. You can't just get in and out, and there is also some management charge. Then you have a balanced fund. Now this one is a balance of both worlds, the very risky equities or shares, and the very conservative investments in money market or in deposits. So that's a balanced fund. It blends the two. And pension funds are actually put in balanced fund. because it's safe to a large extent, but also a bit aggressive, so the returns would be somewhere between 13 and 15%. And for those of us who've been working, you can relate to your pension scheme annual meetings where they come and tell you that we declared a rate of 7, we declared a rate of 15 in a good year, we declared a rate of 10 onto your pension scheme. That is based on the returns from similar funds where they do a combination of those investments. And then a more aggressive one is the equity fund, where you purely invest in shares, local shares, you combine Safaricom and others, you put into the banking stocks and get a return. That would be somewhere between 15 and 20%. Again, this one, you have to go long term. Yeah, you can't invest today and get out tomorrow. You need to build wealth over the long term. Like I talked about Safaricom. If it went to the market at 2 shillings and 50 cents in 08, now we're in 2021 and the share is 41 shillings, you can fathom the kind of return investors have made. It has put money. Millionaires have become billionaires just by buying the share and sitting pretty. Real Estate Investment Trust, this is a new one. It came in 2013, where we are saying some can get into real estate, but some can get into real estate together with all of you, so that we all build a bigger piece of the cake. Rather than having a queen cake, we do a bigger cake and everyone gets a share. Where we are saying the return, and a manager manages this portfolio for us, and therefore they will earn something for themselves. We can get it either as interest or rent income, which is paid to us as the investors. But it's managed by an asset manager, which is very, very good. We are coming to a quick close. We have just a few more slides and we'll be done. Investment opportunities, other than what we've covered so far, is private wealth. Private wealth is more for a bit of the high net worth, because this is more about discretionary. You've now gone into most of the investment funds and you've said, I would want my portfolio looked at by a professional. I have these properties, I have these ones, I would want to prepare a legacy for my family, I may exit the scene, and therefore I would want this to go into generations. I would want to leave my grandchildren with something. But there's no structure. So you come into a private wealth and something is modeled for you and your family. It can be a trust which is put together, and that can come in under private wealth management. And even rental income, fixed deposit, government paper can be in that pool. Insurance policies, land that is just land banked, can all come under that umbrella and can be managed by a professional. And then it leaves the headache, so that the fights you keep seeing in families can be addressed from this perspective. The last one is alternative investments. These are non-traditional approaches. That's where you talk about private equity, where you come in and buy, or venture capital. I get a young man who wants to do some great things, but because he's a young man, he doesn't have the income. And I come in and I say, look, I will support you. I will give you the capital. When you make the return, you pay me off, and then the business is yours. Or we go into a joint venture. These are unique scenarios, but they're there. And they can actually be, because once you retire, this young man or lady will continue to work. For them it will be active, but for you it will be passive. You'll be sitting back and going for the AGM and the board directors meeting to see how the business is doing. How do I develop a winning attitude towards wealth creation? How do I develop a winning attitude? See yourself already in the state you desire to achieve by starting immediately. Let's not procrastinate. If one feels this is the opportunity, I want to get into this. It sounds very simple. Start with 5,000, 10,000, whatever you have, even 2,000, but start. Spend time looking for investment opportunities. They're everywhere. Get to listen, so long as it's authentic. The biggest challenge we have in this country is that we have a lot of scammers. They come and tell you, we'll make you money overnight, weka hii, tutakupea hii, put 5,000 every month, every day, and we put 50,000 today and we'll be giving 5,000 every day for the next 30 days. How and where? Those things don't exist. That's a straight scam. So find opportunities, but also understand those, understand them. Critique, ask questions. So spend time looking out for material on investments, journals, articles, like I said in the beginning. Read widely. And then have sittings with successful people. Listen to them, Read their books. People write a lot. Read. It will take you 1 day or 2 days to read a book of somebody's 40 years in business, 40 years in enterprise. Then you get that knowledge in 2 days, and you can continue doing that. It's important. Read. Take action. Start now. Be accountable. Look for somebody who's you can. And that's why I said that the 5,000, if it's 2,500 from the wife and 2,500 from the husband, you will keep each other accountable. Hey, your 2K for this month, so that we go forward on the next month. You start getting accountable with each other and going together. Engage an expert. Look for someone who can walk you through. Only invest in schemes you understand. I think I've said that. Don't get into things just because your friends are saying, we are making money. There was a company called Desi a few years ago, and it was very well positioned, and it walked away with a lot of money for people. So it's important that we listen, we understand, and finally, let's make savings and investment a way of life. A way of life. The way you have dinner, you have breakfast, you brush your teeth, make investments the same. There is no other way. There's no shortcut about making money and being wealthy. It's the discipline. Have we made mistakes? Yes, we have. We are not just talking about success stories. Yes, we have made mistakes. Underestimating how important it is to look at long term and avoid short term. Understanding the power of compounding. Many of us don't. Now we do. Always a consumer. I'm always on the phone with Safaricom, but I don't own the Safaricom share. So I'm making money for those guys, right? See, I should be making money for myself. My main bank is KCB, but I'm not a shareholder of KCB or Equity or Standard Chartered. Those are the things we're talking about. Be the owner. When other people are making calls, you know. When people are going to Fuliza, when people are going to those surety things, you are the shareholder. So it's putting money in your pocket. And you yourself, when you make the calls, you're paying yourself. Your dividends is coming. The capital gains are coming. All right? So always look at it, not just being a consumer, but be an owner. The second one, the next one is really trusting other people. My employer will sort out my pension. No, sort your pension yourself. Let the company one be in addition to, not as the main one. Build your own. I always thought that I can earn my way through financial freedom in employment. Yes, you can, but by having a serious investment plan. And then lastly is really focusing on assets and not investments. A lot of us focus on assets. Oh, I own a plot here, I own another one there, but it's not generating you anything. You even have a shamba in Mashambani where you have somebody who stays there, and all they do is call you. Mzee, hakuna nini, sijui fence, tunataka kuweka nini, roof in a leak, tuma pesa. So who is the boss? All right? Who is the boss? Is it you or the one in the village saying, tuma pesa tuweke mabati? We need to roof the ceiling, it's leaking. And the water tank is now, we need water. Send a water buzzer. So send me some money to buy water. So those are the things we need to look at. So focus on investments. If that money was in a fund, it would be earning you the return and you sit pretty. After all is said and done, go home with this. 1, understand that it is not an option. Investing is a necessity. It's not an option. Once you leave here, go changed. Be an ambassador about investing. Your children, your grandchildren. If we haven't, let's start talking to them about these things. Ourselves, if we haven't, let's practice this. Secondly, commit and determine whether you need to make some changes. Java or some place for coffee every other day, every other week, and spend some money there, which is good, but that 2,500 has to come from somewhere, right? Because you are not putting it away if you want not. Then you have to pull out something. You have to strike out some luxury. You have to strike out something. Yeah? So you may say, okay, I've been buying lunch. No, I'll now be carrying lunch to the office. And save that money and start putting it away. Something has to give. It can't be the same norm and we expect different results. The third one is create a savings and investment plan. Mine was simple. Start with 5,000, grow it over 25 years, 2.2 million. Easy, straightforward. Yours could be very different. I have these 3 plots I need to consolidate, sell, and put the money. So I don't start with the 5,000 Sam was talking about, but I have some facility, some opportunity, I can put in more and start, but start. So create an investment plan. We are available to talk, to see, to support, to ensure that this becomes a reality. Number 4 is action rigorously and be patient. That's critical. Like we said, it's a way of life, right? You do Bible study, way of life. Exercise, way of life. Eating, way of life. Investing must be a way of life. You must religiously do it. And lastly, and most important, start today. Not tomorrow. Start today. Thank you very much. So there's my contact, feel free. The first one is my cell number. The second one is my email. And the third one is my Twitter handle. I've gone digital. So you can reach me on Twitter. Thank you.
Wonderful. Thank you. Thank you so much. Sam, you will agree with me that that was really loaded and a lot of value which if we incorporated into what we do daily, will be sitting pretty at retirement and enjoying financial freedom at retirement. We have a few minutes, maybe about 5 or 10 only for questions and answers. Mr. Kiraka will be here still at the end of the second session, should there be additional questions, because we were a little behind schedule, but we want to get question and answers. May I ask if there's anyone on the floor who has a question? Okay, can a mic be given?
Yes.
Use the, okay.
Hey, thank you very much indeed. It was a very enlightening topic. And imagining somebody has retired. I personally have retired. We didn't get the opportunity of learning what it is now you're giving. And assuming that we have now retired, and we are not able to work anymore, you are now kind of still enjoying life as you have planned it. There are those who have now done the plans of investing. They have assets, and they are now investing. Now, it comes a time when you now want to look at your family and particularly grandchildren.
Please use the microphone so
Sorry.
that the online audience can also benefit from the question.
Indeed.
And let's
indeed.
keep it short so that we can take a number of them as we go along.
Asante.
Thank
so
you.
my was, what do I do now that I have invested enough and I think I can still leave something for my grandchildren? What's the best way? Because we have seen a plan of trying to leave your legacy for your grandchildren, but then those you live with that to manage that, destroy it, and it falls through. I have an example, probably I may not quote names, but we know them who have left big money. People like Ijenga, and others, probably, just to mention a few. And they trusted this to a trustee or some people. How do we do about that? Sorry for
Thank you. Thank you for that question. I think some you have heard that. Can we take 2 more questions and then he can answer them together? Do you have any other question in the audience? Some of the questions you ask may not necessarily be for you, but just for the benefit of those who are online and may have the same question. Thank you, sir.
Just picking up from where he has left it. We have made all these mistakes. I'm now at that 60. I have received what my employer probably has given me. What is the best advice? What can I do 60 onwards with what I have received?
Thank you. Thank you for that question. So one, how do we manage what is left as legacy investments so that those you leave it for benefit? Secondly, I am 60. We are here. What do we do? What's the best to do at 60? You have 5 years. Sam taught us to count and then figure out what you can do in 5 years. One more question. Anyone under the retirement age? A question under the retirement age so that we have a balanced portfolio of questions. David, might you want to ask something perhaps for the younger generation?
Sam, I would like just to get your opinion. Investing through SACCO, and probably you call it premium investing, or taking a shareholding in a SACCO. What's your opinion, especially for the young people? Rather just look at the ordinary shares. I don't know what your perspective will be around that area.
Thank you very much. Welcome, Sam, to handle those ones.
Thank you very much. Those are good questions. I'll start with Mr. Rufus's question around, yes, it's been a huge giant, made all the money, worked extremely hard, and has now passed on and has left a big portfolio for the children and the grandchildren. How do we secure the wealth that we are making into the second, third, and fourth generation? The only way to do that is to put it in a trust. That's the most secure way of doing it. But then that trust needs to be well managed. It has to be regulated, because when you now register a trust, it actually has to be registered with the government. And once it's registered, then those assets are managed. And there are companies now in this market that are actually offering that service. And I know them, and we work together closely. And therefore, that's a discussion that we can have. But the important thing is this. Those trustees, they take care of the interest of the beneficiaries. So the sponsor will be the family member, and they can appoint 3 trustees to be in charge and give it to a professional company. But there will be members of the family who will be trustees. They could appoint 2, maybe a daughter and a son, or whoever is in the family can actually take that, and then appoint a legal custodian. They can also appoint the firm itself, will then take those portfolios and manage it. So if there is rent, maybe this guy had a block of flats in upmarket or in the normal areas that we know, collecting 1 million shillings, then that goes to that fund. They have some land that is doing coffee in Limuru or up in Kirinyaga and tea, and that income is taken care of. So all those assets can be warehoused within a trust, and that's doable. And that's then the children will continue to get the income from that fund. So it's structured such that if you have medical bills, there is the card, or the money is sent to the insurance company. They organize for insurance health, and the children can benefit or grandchildren can benefit. If it is school fees, you send the invoice for Kilimani Junior or Nairobi Academy or whichever school. It can be annual, can be quarterly, and that invoice is taken there. So it's very, very well managed. And most Kenyans, and we need to think about this. That has happened a lot in the West, and those are the concepts we are bringing to this market. Telling our people, the money that your fathers and grandfathers worked so hard for does not need to go to waste. There are ways we can harness it. The second question was around how do I'm now 60 and I'm retiring. What happens to me? I have a pension that has come of 1 million shillings. We saw that 70% of people retire with less than 1 million shillings. That is not the time to go and start a business and now say, okay, because remember, you're retiring from active employment, because age-wise, if one is able and energetic, that would be very good. But it's advisable to try that out earlier so that the pension is left intact and it can be generating you that, even if it's not a huge amount, but at least you are sure that there's something you can fall back to. So I would encourage, and that's why it's so critical, to start early, so that when you're retiring and you have that 1 million or 2 million shillings, don't get into a business because you could sink it all in. Put it in those investments that we've talked about that are secure. Even if it generates you 10,000 shillings a month. It's okay. It's better than sinking it because that pool is still there. And now try and see how can you use your skill. Assuming you've retired, you are an engineer with the railways. Of course, now it's being done with the high tech, but the guys who are there, who are retiring, most likely are in the old rail. And therefore, they know something about mechanics, right? What can you do in the community today with the engineering background that can help people who are doing sawmill, people who are doing posho mills, that kind of a mindset, and be able to see how can I generate with my skill and passion something that can generate me some income. And stay away from utilizing the pension. I would discourage very much anyone pushing that pension into unsecure, because then once you lose it, then it becomes very difficult. You have to go to your children now for depending on basic things. The last one, David Masai, is a good one. And I thought about it last night. What happens about SACCOs? Because I didn't cover it anywhere. Yeah, so last night when I was going through, I said, yeah, I think there's one scheme that is very popular that I didn't cover, is on pension, is on SACCOs. And the SACCO movement in this country is very huge. It's large. There's opportunities. I mean, we're trying to imagine if you bring the bodas into a SACCO, what that would look like. Because the opportunity in SACCO, building wealth together, you can see a bank like Coop Bank has been made through the SACCO movement over the many years it's been there. And the point here is, if you invest in a SACCO, the usual dividends is somewhere around 10 to 12% a year, which is very similar to what I talked about. Yet it's so easy to save into the SACCO. However, the SACCO must be well run. And I think that has been the challenge. Is the SACCO well run? Because if you may have the SACCO members, 9 of them, then you have the 3 at the supervisory board. If they're in cahoots, you're done. But if it's a professionally run SACCO, the SACCO could even be better because you're able to borrow against your shares and add your investment. Borrow against your shares and add your investment. So besides using that money to go and develop the land or investment, you can use it to grow your wealth. So the SACCO movement is a great, great opportunity. However, you have to look at well-run SACCOs. And they're there. Without naming names, they're there.
Wonderful. Thank you so much for answering those questions. In summary, just look at trusts, which is a paradigm shift from what we are used to, and then looking at the SACCOs. Thank you very much, Sam. To our viewers online, continue to add your questions on the chats. We'll pick them either at this session, as this session goes along, or after the second session, and we'll keep interacting with those. There's a question that was asked a little earlier. How does compound interest work? I know you had said it, but if you can, for example, look at the 60-year-old. You have 5 years to retirement. What sort of amount do I need to put in? What quick math calculations would work for compound interest that would give me a reasonably comfortable retirement return at 65?
Yeah, thanks, Winnie. At 60, to retire at 65 is 5 years. It's a short period. However, 5 years is also a long period, depending on what you want to do. So what happens to a 60-year-old is that they most likely will have bought a few things. Most likely they'll be in their own residence. Most likely they have bought some plot here and there because that's very Kenyan. And therefore now is to make sure that you don't have dead assets that are not generating you anything, dispose them within this 5-period window and bring them to the passive and start generating passive income from them. So you have a plot sitting in Kajiado that you bought from your colleagues, Asako or friends 15 years ago. You bought it for 1 million shillings. It's now worth 8 or 9 or 10 million. That money moves from the land into a fund like this, your freedom fund. So it stops being an idle dead asset, but comes and starts generating. So in the 5 years, if you've been a critical investor of whatever nature, you must have some idle assets sitting somewhere. Dispose of them, and then bring that income to this other side. If you are in a SACCO, you're now retiring, you have your shares in the SACCO, again you pull that out and put them in. You can leave them in a circle to be generating you the return. But with the 5 years, it's a short window. So whatever idle assets you have, please move them from idle to active. When they are active, they will generate you income as you sit, as you prepare for your retirement. When the retirement package comes after 65, then now ensure that you top it up to what you've now received and continue. But in this 5-year window, also look at what will I be doing? Where is my passion? If it is Sam, his passion is talking to people about making themselves rich. So that doesn't need me to put any capital. I just need to use my mouth and a good facility like this one. Yeah? So I don't need to put capital into the business. I just need to go out and talk to investors and show them how to fish. If I show you how to fish and you fish, you will say, Sam, I went and fished and I have something for myself. Let me take you for lunch. And that gets sorted. So my encouragement would be, it's not lost. Even if you are just about to retire, there are opportunities for you to think around what's my passion, and live your passion. There are people who retire, not even because of age, but because they feel they've put away enough and they want to go and try something different that doesn't tie them to the 8 to 5 scam we talked about. Thank you.
Thank you so much, Sam. That's a whole paradigm shift. A lot of Kenyans, or a lot of us perhaps at retirement, are asset rich but cash poor. So we don't have cash flow to be able to do the things we want to do from day to day, but we have mega assets sitting dead. Releasing, letting go of that and turning it into cash flows is important. Thank you so much for those words of wisdom, for answering those questions. I want to encourage us to keep putting our questions on the chat. We'll go to break. We'll take a 10-minute break, and then we will be back for session 2. And I want to encourage especially our online audience, you do not want to miss session 2 with the Reverend Canon Dr. Rosemary Mbogo as she looks at this matter and expounds it further from a slightly different perspective. And then we'll have a very rich engagement with Anthony facilitating thereafter, and Sam will still be on to ensure that we are not asset rich and cash poor. Thank you very much as we go to break, and God bless you. Thank you, Sam.
Thank you.
Okay.